At this point, you should know how to compute basic earnings per share, real income divided by real shares. In this lesson, we compute its more cautious sibling, diluted earnings per share. Diluted EPS answers a what-if question, and companies with convertible securities or stock options are required to report both numbers. By the end of this lesson, you'll have a 4-step routine that handles any diluted EPS problem that could be thrown at you. Here's the scenario. You own shares in a company with a nice, healthy, basic EPS. But lurking on the balance sheet are convertible bonds, debt that can be swapped for common shares. In desk drawers all over headquarters are employee stock options, the right to buy shares at a fixed price. None of those are common shares today, but every one of them could be at someone else's choosing. If they all converted, your slice of the pie gets smaller. Diluted EPS asks, what's the worst my EPS could look if every in-the-money conversion happened? It's a conservative, protect the investor number. And here's the rule that governs everything today. Diluted EPS can never be higher than basic EPS. If a conversion would push EPS up, we leave it out. That's called anti-dilution. And it's the referee of this entire calculation. 3 kinds of securities can dilute EPS. Convertible bonds, debt today, but exchangeable for a set of common shares. Convertible preferred stock, same idea, preferred shares exchangeable for common. And stock options or warrants, the right to buy new shares at a fixed exercise price. Each one of those, if converted, does 2 things at once, something to the numerator and something to the denominator of our basic EPS calculation. That's the key insight. For convertible bonds and convertible preferred stock, we use the if converted method. Pretend the conversion happened on January 1st. Converting bonds means the interest expense in the numerator disappears, which raises net income. And converting preferred stock means the preferred dividends that we normally subtract come back. In both cases, add the new common shares to the denominator as well. Options use a slightly different approach for a specific reason. Exercising stock options brings cash in the door. Remember, we're trying to calculate a hypothetical number. EPS, if everything that could happen to change the number of shares outstanding during the year did happen. How low can EPS go? Cash in the door would certainly affect things, primarily because the company could use that cash to repurchase shares. The FASB invented the treasury stock method to include this possibility in the calculation. We assume that the company immediately uses that cash to buy back its own shares at the average market price. So when options are present, the denominator could grow by new shares and shrink by shares repurchased with the cash. Nothing happens to the numerator though. No interest, no dividends, so the numerator effect is always 0. Before we work through an example of each type of security, here's the routine. You'll want to run this approach identically on every problem, methodically. Step 1, compute basic EPS. Step 2, compute the per share effect of each potentially dilutive security by itself. What's the effect on the numerator divided by what the effect is on the denominator? Then step 3, rank the securities from smallest per share effect to largest, most dilutive first. Step 4, add them to the fraction one at a time in rank order, recomputing EPS at each step and comparing to the previous one. The moment that adding a security makes EPS go up instead of down, throw it out and stop. That security is anti-dilutive. This is why ranking matters. Enter the cheap dilution first, and the expensive candidates have to beat an ever lower bar. All right, let's look at an example. We've been given a bit of information about this company, net income, their tax rate, the number of shares that they've got outstanding. And we've also been given some information about their convertible shares or their potentially dilutive securities. So we've got convertible bonds, convertible preferred stock, and stock options, all 3 in this one problem. So we're going to work through our 4-step process. First, we'll compute basic EPS, and then we'll go through our potentially dilutive securities, the 3 types, and calculate the numerator and denominator effect if they were converted, using the treasury stock method for stock options. Then we'll rank them, and then we'll add them into our basic EPS calculation to see if they make EPS go down. And the goal is to figure out what is the lowest that it could go. Let's start by reviewing our given information. We've been given net income of $1.2 million, and we also have information about convertible bonds, convertible preferred stock, and stock options. Those are all of our potentially dilutive securities. So we'll start by calculating basic earnings per share. So we need to calculate our weighted average shares outstanding, and we've actually been given all of our outstanding stock that was outstanding the entire year. We don't need to weight it. So we'll take that, and that is the total dollar amount. So we're going to divide that by the par value to get the number of weighted shares. 350,000. Again, we didn't have to weight that because they were outstanding for the entire year. Now we can move on to calculating basic earnings per share. And we've been given most of the information we need here pretty clearly. We've got net income, and that was given to us up here at the top. Net income, $1.2 million. And we also have preferred dividends in the form of the amount of preferred stock as a dollar amount, the par value, and the dividend rate. We don't actually need the par value since they gave us the total dollar value of the convertible preferred stock. So we'll take 3 million and we'll multiply it by the dividend rate. And we're going to assume this is cumulative preferred stock where they definitely have to pay the dividend. And we'll take the numerator, which is net income minus preferred dividends, divided by the weighted average shares outstanding to calculate our basic earnings per share. We're going to begin with our bonds, which our numerator effect for bonds is the interest expense that would be avoided if none of these bonds are outstanding anymore because they've been converted to convertible shares. So we're going to take the value of the bonds given to us as $4 million and multiply that by the 6%. And I'm going to go ahead and put parentheses around this because I also need to take the tax effect out of this. If I avoid interest expense and you think about the income statement, I'm not going to have that expense any longer. That means my income will be higher and I will have more tax expense. So I'm going to multiply this by 1 minus the tax rate, which is given to us as 30%. So I'm essentially multiplying this answer for interest expense by 30%. So 168,000 is the amount of interest expense that I would avoid. Now I need to know how many new shares of stock would be outstanding. Remember, my denominator is 350,000 right now. And if all of these bonds were converted into common shares, I would have more shares outstanding. So let's look at how many more shares. There are $4 million worth of bonds. They are convertible into 250,000 shares. And they've given us that number. We don't have to do any calculations. Sometimes you will have to do calculations, but they've given us the number of 250,000 shares that would be outstanding. So that is our numerator and our denominator effect. If I take the numerator and divide it by the denominator, then I get the per share effect of 0.67, and I just need to compare that to my 2.74 basic earnings per share. So I'm going to put that right here and show that this is in fact less than 2.74, which means that these potentially dilutive shares or potentially dilutive securities are in fact dilutive and should move on to the next step where I add them into my basic earnings per share calculation in order to determine how low it could go. Next up is preferred stock, and my numerator effect is the dividends that I would not have to pay if I do not have these shares outstanding, and that we've already calculated up here as $240,000, so I would add that back to my numerator. I would no longer need to subtract that from my numerator if these preferred shares did not exist because they had been exercised into and convertible into common shares. The denominator effect is how many new common shares will be outstanding. So going up here and looking at our convertible preferred stock, it's convertible into 8 shares of common stock per share of preferred stock. So first I need to figure out how many shares of preferred stock I have. I'm going to start a parenthesis, open a parenthesis, divide 3 million by the par value. And that is going to give me the number of preferred shares. And then I'll multiply that by 8 to get 120,000. To determine the per share effect, I simply divide the numerator by the denominator, giving me my per share effect of $2. Again, I'm going to compare this to my basic earnings per share to determine whether or not, and I'll just type in 2.74, to determine whether or not that is less, and it is. So this is in fact potentially dilutive. Next up is our options. The numerator effect of stock options is always going to be 0. There's no interest expense and there's no effect on net income if options are exercised. When options are exercised, we simply receive some cash from whoever had those options. They exercise their option, they pay cash in exchange for a common share. So the numerator effect is 0, but there is a denominator effect, and it's going to be twofold. First, we're going to get some cash if they are exercised. So we need to calculate how much cash we're going to get. So if we look at these stock options, we're going to have 60,000 stock options. They're convertible into 1 share each of common stock. So I'll have 60,000 and I'll have $35 per option if they are in fact exercised. So that's $2.1 million. That $2.1 million, if I take that and divide that by the average share price, which was given to us as $40, that gives me about how many common shares that I could purchase with that new cash. And so that would be our potential treasury stock that we would purchase. And remember, this is the treasury stock method under GAAP, and it's a creative way to get the possibility that companies repurchase shares as treasury stock into our diluted earnings per share calculation, which is simply an estimate. So the new shares that we would have outstanding would be those 60,000 options, again, each convertible into 1 new share of stock. So that's my my other denominator effect. So the denominator effect has a positive and a negative. I would have both 60,000 new shares outstanding minus the 52,500 shares that I would repurchase. So the net effect is 7,500. Now this is always going to be zero, the numerator divided by the denominator, because the numerator effect is always zero. We don't necessarily need to do this calculation here where we put our basic EPS right here, but we can just to show that this is the step and this is dilutive. Next up, we're going to rank our dilutive securities in order of which one is the most to the least dilutive. So the first most dilutive is the one that has the smallest effect, right? The smallest per share effect is the most dilutive. Then the second is going to be our bonds of 0.667. So bonds are the next dilutive, and then our preferred stock. So this is the order in which we're going to add those dilutive securities into our basic earnings per share calculation. Because remember, as we start adding them one at a time, we might find that the number goes up, in which case we don't want to go any further. We want to stop. We want to know what is the lowest it can go. So my numerator in basic earnings per share in this first step is what I calculated up here as 1.2 minus 240. Now I'm going to add in the numerator of my most dilutive security, which is my options. So I'm going to add 0 to that numerator effect. My denominator is my weighted average shares outstanding in my basic earnings per share calculation, and I add in my denominator effect of the options. So that is my new numerator and denominator. And if I take that and then compare that to my basic earnings per share, I'll be able to determine whether or not this is in fact lower and if I should proceed. And it is. So this is dilutive, not individually. This is dilutive in the collective. These options are definitely dilutive even in the collective. They were already dilutive individually. Now we know they are dilutive in the collective, which means we need to include it in our calculation. Next up, I'm going to start with my numerator effect from the options. Those were dilutive. 2.69 is in fact lower if I include those. So now I'm going to keep going. I'm going to take the numerator effect from the last step and I'm going to add the numerator effect if the bonds are converted. So if the bonds were converted, I would have a $168,000 impact on my numerator, more income because less interest expense. And then I would have a positive impact on my denominator as well. So I'll start with the 357.5 and I'll add in the denominator effect of my bonds. Instead of comparing this number to basic earnings per share, though, I am going to be comparing it to my last calculation, right? Last I determined 2.69 is in fact lower. It could be my diluted earnings per share, but it looks like it actually can go lower. So it is lower than 2.69. So it might be my diluted earnings per share. This is a dilutive security in the collective. I need to keep going though. And I'm going to start with my numerator effect of the bonds from the last step and add the numerator effect if all the preferred shares were outstanding. So I'll add $240,000. That would be the preferred dividends that I would avoid if they were all converted. Then I'll start with my denominator effect of the bonds from the last step and add the denominator effect of the preferred shares, which would be the new shares that would be outstanding if they were converted. And I will get my new diluted earnings per share calculation. It's 1.88. I need to compare it to the last step, and it is actually higher. Right? So I do not want to start here. This is anti-dilutive. It is not smaller, right? It is not in fact smaller than 1.86. So 1.86 is how low it can go. And that is our final dilutive earnings per share number, 1.86. If you apply this methodical approach to every problem, you'll always arrive at the correct number.
To wrap up, diluted EPS is the worst case scenario. What is the absolute lowest that EPS could go if everything that could happen did happen? Calculate the per share effect of all potentially dilutive securities using the appropriate method. Convertible securities use the if converted method. If these securities were converted, what happens to the numerator and denominator in the basic EPS calculation? And options use the treasury stock method. And we only care about the denominator. If all the options were exercised, add the new shares that would be outstanding and subtract the treasury shares that could be purchased with the influx of cash. Use the same methodical approach every time and you can't go wrong.